Reality TV star Pinky Cole has agreed to give up her home in bankruptcy. Let's go.
This is Pocket Watching with JT.
Hey, Pocket Watchers. I am certified financial planner Jayson Thornton, and this is the Bankruptcy Breakdown. This is where I react to the financial failures of your favorite celebrities and influencers so you can get the financial lesson without going through the trouble. Let's go pocket watching. On this episode, I will be reacting to the recent update for the bankruptcy of Pinky Cole. But before I dig into the numbers, let's give this sister her flowers. Aisha Pinky Cole was born in 1987. She is the founder and CEO of the wildly successful restaurant brand Slutty Vegan. She was named to Time Magazine's Next 100 list. Now, during its peak, her company that she started from scratch, her company had the evaluation of $100 million. Let me say that again. Her company was valued at $100 million. Now, recently, she has become a cast member of the very successful The Real Housewives of Atlanta reality TV show. And on top of all of that, she has recently partnered with the good brothers over at EYL to launch a financial literacy music series. So the question we have to ask ourselves is, how do we end up here? How do we end up on Pocket Watching with JT? Well, according to the paperwork, Miss Aisha Pinky Cole officially filed for Chapter 11 bankruptcy on February the 12th, 2026. Now, for those of you who are unaware, I've already done an episode on her. I've gone over her filing for bankruptcy before. This is the update. But for those of you who need a refresher, let's go over it together. Now, the Pinky Cole bankruptcy breakdown. Now, in 2018, this woman, starting from basically nothing, created the Slutty Vegan brand in Atlanta, Georgia, and it absolutely went viral. Just a few years after starting the brand. Remember, she started in 2018. A few years after starting the brand in 2022, her company receives a valuation of $100 million. Now, how could this be? Well, it is because she was able to raise $25 million from investors. So if you're able to raise $25 million from investors, and those investors now own about 25% of your company, then that means automatically your company, the whole thing, must be worth $100 million. All right, now follow me here. But just a few years after that, we already see some trouble. By 2024, the company is weighed down by way too much debt and not enough revenue. Because in early 2025, she enters into a state-level bankruptcy where she actually gives up control of the company. Let's go over that. On February the 13th, 2025, she enters into what is referred to as an assignment for the benefit of creditors. Once again, this is basically a state-level bankruptcy. This is where you turn over your company to a third-party independent trustee, and it's their job to liquidate as much as they can to pay off your creditors, the people who you owe money to. So it's basically bankruptcy just on the state level. During this time, Pinky Cole no longer had control or ownership of the brand that she started. But as the story goes, on March the 28th, 2025, she comes back. Slutty Vegan 2.0. She buys back her company out of this state level bankruptcy under the new corporate name, Ain't Nobody Coming to See You, Otis, LLC. That is not a joke. That is real. She buys back her company with a shell company called Ain't Nobody Coming to See You, Otis. Now, this sounds like a great ending of the story. She builds up this brand, financial mismanagement. She loses the brand, but then she buys it back. But here's the problem. When she buys the company back with this new LLC, Ain't Nobody Coming to See You, Otis, she has to borrow a lot of money. She borrows so much that she is way over her head in debt again. Remember, she had to go through the state level bankruptcy because there was too much debt. She then buys back the company, but she borrows money to buy back the company, and she's right back in debt again. This is why in January of 2026, she files for bankruptcy for the very first time. Now, I did not know this the first time I did the episode on Pinky Code. This is new information for the Pocket Watchers. So in January of 2026, she files for bankruptcy on the federal level for the very first time, but she files for Chapter 13 bankruptcy, not Chapter 11. What's the problem with that? All right, we'll get into it. On the screen right now, you see the original bankruptcy that she filed for. This was on January the 21st, 2026. She files it. And as you can see, she clearly strikes out Chapter 11 and she puts a big check mark by Chapter 13. Here it is again. She is clearly stating, I am filing for Chapter 13 bankruptcy, not Chapter 11. What are the problems? Well, problem number one is that Pinky Cole files this by herself, meaning without an attorney. What's the problem here? Well, we have a company that just a few years ago was supposed to be worth $100 million. You already filed for the state level bankruptcy. You're able to buy your brand back, but you go into debt to buy the brand back. And it's not even a full year later, you're filing for federal bankruptcy, but you're doing it by yourself. That seems a bit odd, right? So here is our affidavit saying, I'm doing this all by myself. Now, the other issue is this. That Chapter 13 bankruptcy is almost immediately dismissed. And it's dismissed because she does not pay the filing fee. Okay. Another red flag. $100 million brand, you can't pay the bankruptcy filing fee, which is less than like $2,000, right? Less than $2,000. But this actually works in Pinky Cole's favor. Let me explain why. Chapter 13 is the wrong type of bankruptcy for her in this situation. Okay. In general, there is Chapter 7 bankruptcy. That's the bankruptcy that most people think about. It's the total liquidation bankruptcy. It's the, hey, I can't pay this debt. I want to walk away from my debt. I'm going to keep the few things that I can keep. Everything else you guys can have, and I'm walking away from the debt. That's total liquidation bankruptcy. That's not what we're talking about here. There's two different types of payment plan bankruptcy. Chapter 13 and Chapter 11. These are two payment plan bankruptcies. These are the type of bankruptcies where you try to keep everything that you got, but you set up a payment plan to pay off your debts. Chapter 13 is for individuals. Chapter 11 is for businesses and high net worth people who have businesses and things of that nature. Why does Chapter 13 not work for Pinky Cole? The reason why it doesn't work for Pinky Cole is Chapter 13 has a cap on the amount of debt that you can pull into a Chapter 13 bankruptcy, and the debt that she has is over that cap. So that didn't make any sense. Also, The reason why Chapter 13 doesn't work for her is because Chapter 13 only protects you as an individual. It doesn't also protect your company from the creditors. So if she went through with the Chapter 13, it doesn't matter. Her creditors could still go after the LLCs, and she's trying to keep the companies running. So Chapter 13 makes no sense. Chapter 11, that's the one that she should do. And she would have known this if she hired an attorney. I'm sure an attorney would have told her the right type of bankruptcy to file. But the very next day, after the Chapter 13 is dismissed, she then re-ups on February the 12th. Remember, February the 11th, Chapter 13 is dismissed. February the 12th, she then goes back and she files for Chapter 11. Okay, this is the right type of bankruptcy. So she's doing good. She's picking the right type of bankruptcy this time. The problem is, once again, she's doing it pro se. She's doing it on her own. She's not a bankruptcy expert. She should not be filing bankruptcy on her own. But hey, it's a free country. She does it. Once again, she files pro se. She's doing this, but she's doing it with Chapter 11 this time. All right. Now, here's another red flag. Oh, she still has a problem paying the filing fee. Remember, the Chapter 13 was dismissed because she didn't pay the filing fee. We have the bankruptcy court notifying her again, listen, there's going to be a problem. They're ordering her on February the 23rd. So she files this Chapter 11 one day after the Chapter 13 is dismissed. By February the 23rd, the court is telling her again, listen, you got to pay the filing fee. The filing fee is less than $2,000. It's $1,738. They even tell her, listen, if you've got a problem paying us the full $1,738, we'll accept a payment plan. We can chop it up. Just pay us $339 and we'll set you up on a payment plan. But if you don't pay us, we're going to dismiss this Chapter 11 the same way we dismissed the Chapter 13. Now, to her credit, eventually, this woman was able to pay the filing fee and the Chapter 11 bankruptcy is able to proceed. All right. Now, when she files this Chapter 11, she discloses the income and the expenses that she currently has. Based on her own numbers that she reported, she is bleeding cash every single month in the amount of $27,117. What does that mean? Based on her own numbers, she brings in $14,583 monthly income. The problem is her expenses. Her expenses are $41,700 a month. This is why she's in the red, $27,117 every single month. This is why you file for bankruptcy. This is a problem. All right. So, to her credit, by March the 11th, 2026, this woman finally comes to her senses. She finally realizes it's time for me to hire a professional, not some fake guru that she may find online, but a real life certified and licensed professional to help her in this bankruptcy. March the 11th, 2026, she hires a law firm to represent her in this bankruptcy. Now, I think I understand why she did it. It's not because she just came to her senses. It's because she was forced to do it. Here's why I think she was forced. On February the 20th, 2026, according to the paperwork, one of her creditors locked her out of her Loganville, Georgia investment property. Okay. She was smart enough to realize she does not have the legal expertise to enforce her rights in bankruptcy. So when you file for a bankruptcy, you receive what's referred to as an automatic stay. An automatic stay is basically when you hit the pause button. You file for bankruptcy, you hit the pause button. That means while you're in bankruptcy, while you're working things out, none of your creditors can enforce any type of collection activity. They cannot take your car. They cannot take your home. They cannot go into your bank account, take your money. They cannot go after wage garnishments. Everything's on pause. The problem is this company, they didn't pause. They took action and took over the Loganville, Georgia investment property. So I'm thinking she realized she needs to hire an attorney, and the attorneys did their job. They were able to get her control and possession of that property back because there is an automatic stay. So shouts out for her. She realized it's time to call in the professionals. Now, let's go over the Chapter 11 bankruptcy plan. Now, remember, Chapter 11 and Chapter 13 are payment plan bankruptcies. It's where you come up with a plan of how you are going to make payments to the people who you owe so you can come out of bankruptcy and not lose your stuff. Okay? Chapter 7, you can lose your stuff in Chapter 7. Some things you can keep. There's assets that are exempt, but anything over the exemption, you're going to lose your stuff. Chapter 11 and Chapter 13, you're able to keep your stuff if you come up with a reasonable payment plan that both your creditors and the court agree to. So here is the plan that she and her attorneys come up with. Pay attention to this. Now, remember, this company was supposed to be worth $100 million in 2022. Not so much in 2026. Let's take a look at this payment plan. Focus on this. The company's supposed to be worth $100 million just a few years ago. Here is a list of all the companies that Pinky Cole and her attorneys file claiming this is what she owns. These are her the interests that she has in various companies. Pay attention. Pinky Cole Enterprises LLC. She owns 85% of that company. Ain't nobody coming to see you, Otis. She owns 100% of that company. Vogie's Franchise LLC. She owns 100% of that company, but that company's not even operating. She owns 50% of a holding company called Cole and Hayes 28 Enterprises LLC. I believe this is a holding company that she owns jointly with her husband. She owns 50% of this company. Then there is the Pinky Cole Group LLC. She owns 85% of that. Slutty Vegan Franchise. She owns 85% of that. Then there's Vogie's Inc. She owns 85% of that, but that company, once again, this one is not operating. Then there is American Sheesh LLC. She owns 85% of that, but once again, this is a company that's not operating. And then there is the Pinky Cole Foundation Incorporated. She owns 100% of that company, but that company is listed as being not operating. And she also owns 100% of Sidonia Properties LLC. She owns that 100%. Now, pay attention to the list of zeros on the other side of the screen. You have a list of companies, how much of that company she owns, and then there's this list of zeros. What could these zeros represent? Well, according to the paperwork, those zeros represents what the company is worth. Yes, all of these companies, based on what she filed, has a zero liquidation value. What does that mean? All right. So in the financial world, we have a very simple formula to come up. How much are you as an individual or the company is worth? What is your net worth? Very simple formula. It goes like this: assets minus liabilities equal your net worth. So what do? We add up all your assets, all the things that you own. Then we add up all your debts, all the money that you owe. We then subtract what you owe from what you own. The number that's left, that's your net worth. Based on this, all of the companies that she has listed has a zero net worth. Actually, if you dig into the numbers even deeper, she explains that actually when you add it all up, it's not zero, it's a negative number. That means she owes way more money than any and all of these companies combined. She has a negative net worth in all of these companies. Remember, not too long ago, it was supposed to be worth $100 million. All right, let's keep this going. So, how is this payment plan going to work? This is, according to the paperwork she filed, this is how the payment plan is supposed to work. She is going to pay $4,620 a month for 60 months. Okay? That money is going to be split up between the Georgia Department of Revenue, the IRS, the Internal Revenue Service, also various home associations that have liens, right? She also has court fees that she has to pay, and there's unsecured creditors, right? $4,620 a month represents, based on her numbers, 77% of her monthly income. Before, she claimed that she was making over $14,000 a month. But now, based on this payment plan, she's claiming that she's going to be bringing in $6,000 a month. 14,000 down to $6,000 a month. That means only 23% of the money that she makes a month can she actually spend on herself and her family. This is her own payment plan. She's claiming that she's going to spend $200 a month on the kids, $800 a month on groceries, $80 a month on gas. I don't know how she's doing that. $80 a month on gas, $300 a month on medical. Okay, that's $1,380 every month she can spend on basically personal stuff. Everything else is going towards the debt. Now, this payment plan is very, very low, right? This is less than $5,000 a month going to her creditors, the people who she owes money to. How can this work when she owes millions of dollars, right? How can this payment plan actually work? She's not making enough money. She's not paying enough money to pay off millions and millions of dollars debt. Let me show you. We've got an answer. We've got an answer. She has to give some stuff up. Now, this is her payment plan. No one's forcing her to do this. This is her payment plan. In order for this thing to work, she has to give up some assets. Here are the assets that she's given up. She is giving up her personal home, right? The Montrose Drive property in Georgia. Why? Because she owes $1,481,312.27, right? She owes that on the mortgage. So she says, listen, I'm just going to give you out a house. I'm going to give you out a house. That way the debt's gone. I'm just going to give you guys the house. So this is her personal home she's giving up. She's given up the investment property on Browns Mill Road in Atlanta, Georgia. She owes $292,566.41. She's giving that back to the bank. Then there's an investment property on Avanti Way in Decatur, Georgia. That is $189,308.16. She owes on that property. She's given that back. Now, this property actually has some equity of $8,091.84, but she's giving everything. She's forfeiting the little bit of equity that she's got. Then there's the Loganville property. Remember, I think this is the same property that she got locked out of before. She's giving that property up, right? It's she owes $307,944.93 on that property. She's giving that one up, and she's got $55,103 in equity in that property. She's giving that up, right? She's just giving the property and walking away from the debt. Now, I want you to pay attention to something here. For those of you who have been following this story, when this first broke out and people found out that Pinky Cole was filing for bankruptcy, she came out with a few Instagram posts. Yeah, she went out to Instagram and she was trolling some people who she said misunderstood how bankruptcy works. She made a video mocking people thinking that she was going to get kicked out of her home. You see it? This is her acting as if all of a sudden, because she filed for bankruptcy, she's going to lose her home. She did a little musical dance and all this stuff about teaching people how bankruptcy works and how you get to keep all of your assets if you file for bankruptcy the right way. But it's kind of funny or ironic that the bankruptcy plan that her and her attorneys comes up with, the very home that I believe she's play acting in as if she's going to lose her home, is listed that she's going to give it up. She's giving up her home. Why? Because she does not make enough money to satisfy a real payment plan in bankruptcy to keep the properties. So she's given up that personal home. She's given up the investment properties. Now, some of you may be saying, well, JT, how do you know that's her personal home? That could just be one of the investment properties. She has a husband. Husband's supposed to be a millionaire. They probably own another home. That could be the case. But I just want to point out something here. In the bankruptcy, she lists where you live. This is supposed to be your primary residence, right? You're supposed to tell the bankruptcy court, where do you live? What is your primary residence? And she lists the Mount Rose Drive property as where she lives. And then she lists the Mount Rose Drive property as one of the assets she is giving up in order to keep her LLCs. Yes, she's doing all of this to keep these worthless companies, okay? She's giving up her personal residence. She's giving up her investment properties. She's given up 77% of her monthly income in order to keep these so-called worthless properties. Now, to be clear, if everything works out the way that she plans, these companies should start to have value because the debt will go down when she gets out of bankruptcy. The companies should then now have value, I suppose, but it's not going to be $100 million, right? And some of these properties, like the holding company and stuff like that with her husband, I mean, that's not even in the bankruptcy, and she still says that's worth zero. So listen, she's got a very, very, very long road to go for everything to work out for her. And listen, there's a part of me that's rooting for her. It's rooting for her. But here's the thing. She has to make every single payment on time. If she does not make every single payment on time, all of this is for nothing. It all goes away. Even though she already gave up her personal home, the investment properties, if she falls off on her payment plan, the debt just comes back. Maybe not on the properties because she turned in the properties, but she's still dealing with the rest of the debt. All right. So we've got to learn a lesson here. We're not here to just laugh at another person's situation. No. This is a teachable moment. This is why I created this content, for you to understand that you can get drunk off debt. I don't care how many people are online telling you that you can become a multi-millionaire. All you have to do is get business funded. All you have to do is get a bunch of credit cards and liquidate the credit cards to start a company. And all. This is what happens, all right? This is what happens when you take on way too much debt and you do not have the proper plan, the proper experience, or the business to pay the debt back. So this is why This is why I'm offering you guys the Pocket Watcher 7 money rules. Okay? Pocket Watcher 7 money rules. Here we go. Step number 1, budgeting. If Pinky Cole had the right budget, she never would have ended up in bankruptcy. Number 2, you got to have an emergency savings fund. Because when things happen, you can't just run to a credit card when an accident happened, when you have to pay off a bill, unexpected medical costs, whatever it is. You have to have an emergency fund that keeps you out of debt. That takes us step number 3, right? Step number 3 is proper debt planning. If you do have debt, have an active plan of how you're going to get everything paid off. Stop kicking the can down the road, or you're going to end up in bankruptcy. Figure out exactly what payments you need to make on each debt each month to get out of debt as fast as possible. Insurance planning. Having the right insurance can save you in a crazy situation. Health insurance, life insurance, if people are dependent on your income, make sure you have the right insurance plan. Tax planning. As you see, Pinky Cole, she owed the IRS, she owed the state of Georgia back taxes. You have to have a plan for how you're going to pay your taxes. And make sure you're taking advantage of every legal loophole to pay as little as possible. Then there's wealth planning. You have to be putting money away a little each month for your retirement. Okay? Step number 7, estate planning. If you follow step 1 through 6, that means you have something. You built some wealth. Step number 7 is your active plan of how you're going to transfer that wealth from yourself to the next generation. Those are the 7 Pocket Watcher money rules. And if you need help on how to follow these rules, go to my website, pocketwatcher.net, sign up for the free Pocket Watcher app. Inside that app, you can create your budget, you can track your debt, and I have a step-by-step process of how to follow the 7 Pocket Watcher money rules. And if you have a question for the Pocket Watcher, you have a tax problem, you're living paycheck to paycheck, you're trying to figure out what to do, you can sign up for a free phone consultation with me. Go to the same website, pocketwatcher.net, sign up for the free phone consultation. And of course, if there is a celebrity or influencer who has filed for bankruptcy, or maybe they have been hit with a fraud charge from the federal government, or maybe they filed a lawsuit claiming that they're the victim of fraud, put their name and information down in the comments of this video, and I will try to get you guys some more content as soon as possible. Thanks for watching.
Are you looking for real financial advice? Thornton Financial is here to help. Certified financial planner Jayson Thornton specializes in tax and wealth planning. Are you living paycheck to paycheck with no retirement plan? Do you need help with the IRS? Book your free consultation with Thornton Financial today. Budgeting, savings, debt management, and retirement. Even tax debt settlements. Get the advice you need to live your best life. Book your free consultation appointment today. Go to www.thornton-financial.com.